we are going to give you our presentation on the business valuation on Cerenimbus software development. All right, a little history on the business. It was founded in 2010, but the CEO went full-time in 2014. There's a 5-year track record of positive cash flows, and as of right now, it's limited capital assets, but as of 2017, there are $2 million sitting on the balance sheet, which is exceptional for this type of business. Why do they exist? They are a software solutions company that services small to medium-sized businesses that don't have the capacity to do in-house type of software development. They specialize in mobile apps, desktop applications, and websites. Kind of the breakdown of the equity of the business: 40% goes to the founder, 4% goes to 2 associates, and 56% goes to an equity firm.
Alright, so the organizational structure of the company, there are currently about 69 employees. 15 of them are local, and the rest of them are programmers in the Philippines. And there's pretty much just the founder and about 8 other employees that kind of go out and try to get contract work for the company. And then the rest are kind of just, there's 3 programmers that work here locally, and then 3 support staff. And pretty much everyone except for the 2 associates and the founder are paid hourly, and the other 3 are paid on salary.
Okay, the competitive advantage that this company has, but more specialization that they have, they've mastered the art of being able to manage highly productive, lower wage programmers in a foreign country. So like Louise mentioned, 55 employees are out of the country. We only have
15 local.
15 local, yeah, I was remembering the other ones. They specialize in this type of field because few firms can actually do that. Few firms have attempted to try this type of production method, but the long distance, the time zone differences, and just being able to travel to those foreign countries gets difficult, and it's highly expensive.
Alright, so there's also expansion plans to kind of, I guess, pretty much double their workforce, mainly in the foreign countries. But they're planning on getting at least 2 local employees to kind of help out with getting more contracts for the company. And then 30 more, they're planning on getting 30 more to for the foreign markets to be programmers, and kind of right now they're sort of looking into other economies to see where that would be best for them, and currently they're looking in India to see if that will pan out for them in the long term.
And along with the expansion plan, they're looking at blockchain technology. Right now it's in the conceptual phase, but Kirby, the CEO of this company, he's very optimistic about it. He mentioned on our phone call that similar to Bitcoin, they want to ride that wave. So they're looking into that type of expansion and that type of development.
When conducting the industry analysis, we determined that the company, Cerenimbus, ultimately falls into the IT consulting, and for a few different reasons. Really, the definition of what we do is supporting customer software and detailing that to a kind of very specialized customer clientele. They're looking for a very specific solution to some of their needs as far as software goes. Some of the other main focuses of what really classified them in this category was the low capital requirements, the ease of exit and entry into the industry, as well as a lot of the individuals that work for these companies, these small tech companies in the consulting sphere, typically have contracted out employees, or they have very, very small numbers of employees, as Louise and Cam mentioned. Some of the primary functions are to provide expert technology to these clients, and also to provide support for them as well. Kind of looking holistically and kind of analytically at the industry, The annualized growth rate for the next 5 years moving forward into 2023 is expected at 3%. For the past 5 previous years, it's been at 3.3%. Kuchara will explain this a little bit more further into the presentation, but we took that 3% growth rate and we added a little bit more to it. We felt that the company really was going to perform quite well in this sphere, and for a number of different reasons we'll talk about and express a little bit later. Most of the demand that is pushing in this industry is coming from the finance or fintech industries, along with the insurance industries. We've seen that a lot of the private development that is going into this sphere, of the IT consulting arena, is really kind of spurring demand on. And ultimately, some of the key drivers are the multiple access points. People have much more availability as far as being able to access technology from any point, anytime, anywhere. That's also driving demand. Private investment is pushing it forward, as well as we talked about some of the blockchain technology as well. Looking at the government contract or state contracts, that plays kind of for us, it plays actually a fairly significant portion. 15 to 17% year over year for the next 5 years is what we're anticipating as far as growth in that arena. And so for us, government contracts really are kind of a driving force ultimately, not only for this industry, but specifically for Cerenimbus and what we're hoping to accomplish with the company.
Okay, on the call with the CEO, he mentioned that the primary motivation behind this valuation is to issue options to some key employees. Taking that into consideration, we came up with a concluded value of roughly $12.7 million, because you don't want to be too aggressive on your valuation, as that would not properly incentivize the people to whom they give the stock options, and you don't want to understate the value, as that would that would have tax implications too. And so we considered a asset approach, or otherwise known as a cost to recreate approach. However, because of the stage of the company, at this point we no longer deem it appropriate for Cerenimbus. However, the income approach, specifically the DCF, we thought to be appropriate, as the company provided us with their forecast, and in addition to that, we also considered a market approach appropriate, as we found good multiples, to which Oscar will speak in a little bit. And then ultimately, we also did a kind of a hybrid, where we had an explicit period, a DCF, and a exit multiple. And altogether, as they came in fairly close and similar, and we had equal confidence in these three methods, we decided to weigh them equally, and came up with a concluded value of $12.7 million.
So as Michael has mentioned, the first approach that we use is the income approach, which is just a basic discount cash flow. And to do this, we also look at, well, the company gives us a required rate of return of 18%, but then we also want to look at this from the weighted average cost of capital. And to do this, we calculated the cost of equity using the built-up method, which takes into account the risk-free rate, equity risk premium, industry risk premium, size risk premium, and the specific company risk premium. And we wanted to do this rather than doing a CAPM, because the size of the company is relatively small. So we feel like the beta of large industries or large competitors doesn't really fit into this context. So this cost of equity, we get a 20.45%, which we take into account because we don't know what the market value of the firm is. We use a industry average total cost of equity over cost of debt over equity, and we get an 81% market value. So our weighted average cost of capital comes out at 17.59% at a tax rate of 21%, sorry. Which gives our DCF valuation of $11,404,000 using this method. We also used the exit multiple method using the DCF, which at the same cost of capital, 17.59%, and with the EV over EBITDA, where Oscar will explain later why we're using this, of 7.34%. So using this method, we get a valuation of $14,248,000. So, sorry, using the 5% growth rate, which, as we said, the industry growth rate is at 3% in long term, but because the company is heavily reliant, they're pretty much relying on their growth to come from the blockchain industry that they're stepping into, and blockchain industry is growing at a super aggressive rate. Industry growth is projected at 50% even, 52%. So we decided to add an extra couple percentage to the long-term growth rate. So that's why we have a 5%, which is relatively aggressive, we believe, and that gives our revenue increase to $12 million, to about $15 million in 2023, and that is because their income are growing at a rate of roughly 16% year over year for the next 4 years, and then our long-term growth rate of 5%.
Okay, so for the third module, we're looking at market approach. So market approach is basically looking at a peer group of companies, comparable companies, and finding a multiple or transaction price for similar companies. So for Cerenimbus, we've been looking at private transactions over the last 5 years in the industry of computer programming services and IT consulting. The comparables are sorted by sales, profit margins, and assets within the same range to kind of narrow it down. And I've also adjusted for outliers that did not follow the same trend or business models. So we see how we came up with 7.33 or 34. We can do the next. To value this, we are using the private transactions with the sample size of 14 multiples that we could come up with, and we then found the EBITDA multiple of 7.34. We're using the EBITDA multiple because the industry has a proven track record, and Cerenimbus as well is performing well. That also is laid in the ground for choosing a median multiple, as the company's performance is similar to the other companies. So we're multiplying this with the last reported EBITDA for 2017, that was $1.693 million, and get the market approach value of $12.427 million. And that is fairly similar to the income approach value, and we're pretty happy about that.
In conclusion, we took into consideration that they're a services business as of this point, and that's how we valued it. That's how we determined the industry to be IT consulting and not yet a fully software service, and therefore that's how we chose the industry report and how we analyzed the industry. Because of the stage of the company, that's how we chose the 3 different methods: the DCF, the market multiple of 7.34, and a hybrid method, and came out to a concluded value of $12.7 million. And yeah, the blockchain we determined as of now has not been materialized, and therefore we didn't take that into consideration and value it as a consulting business.